Good morning, good afternoon, good evening. Thanks for joining us at Financial Statements at the Peterson Institute for International Economics. I'm Nicolas Véron. It's my pleasure to introduce this session. And once again, we go back to Basel, the holy center of the financial world, and especially the Basel Committee on Banking Supervision, which sets standards for banking, capital liquidity, risk management, and much else. We have discussed Basel III and the so-called Basel III endgame, which is controversial in the United States in a recent session. This session is forward-looking, so beyond Basel III, what is on the agenda of the Basel Committee, and we can have better speakers, of course, to discuss that than the Secretary General of the Basel Committee, Esho, and Isabelle Vaillant at the European Banking Authority, who will give us a perspective from closer to the grassroots, even so it is a high European level. Esho studied at the University of Sydney from 1987. He then was at the University of South Wales, also in Sydney. He got his PhD in finance there. He was a senior lecturer at the University of South Wales until 2001 at the School of Banking and Finance. In 2001, he joined the Australian Prudential Regulatory Authority, the APRA, as head of research, and 5 years later, in 2006, the Basel Committee, where he has worked ever since. Deputy Secretary General in 2014, Secretary General since 2022, replacing Caroline Rogers when she went to Canada, and obviously very versed in all the arcana of any dimension of banking regulation. Isabelle Vaillant studied at Sciences Po in Paris. Isabelle, I think your dissertation at Sciences Po back in 83 was La Banque à service public, ? Banking service, is it a public good? So that has a question that has not really gone away in the meantime. Then studied at University Paris 10, joined the Bank of France in 1986 as an economist in the research department in a number of different positions having to deal with regulation at the European and international level. Isabelle was in charge of large financial institutions, including BNP Paribas and Société Générale in the early 2000s. She was also deputy director for European and international affairs, went to a secondment to the French Securities Authority, the AMF, in 2010. And in 2011, Isabelle Vaillant joined the newly created European Banking Authority, where she also has been ever since, and always in charge of regulation and policy, basically the guardian of European doctrine at the European Banking Authority. Of course, the European Banking Authority is distinct for European connoisseurs from the European Banking Supervision, the single supervisory mechanism centered at the ECB, plays a complementary role by focusing on regulation and rulemaking for banking and a number of other duties. So we'll come back to that. But first, Neil, over to you.
Okay, thank you, Nicolas, and thank you for the introduction and the opportunity to participate today. I'm going to try and just quickly share my slides. Let me know if it works okay. Is that okay? Okay, good. Okay, in my introductory presentation, I'm going to cover three broad topics. You said this was going to be forward-looking. Unfortunately, forward-looking still means talking about Basel III implementation. I wish that wasn't the case, but that is, unfortunately. So I'm going to cover Basel III implementation. Secondly, the Basel Committee's response to the 2023 banking turmoil. And then quickly, the committee's work program for 2024. I've listed 5 key themes here in this slide. I know I'm not going to have time to cover them in detail because Nicolas has told me I only have 10 minutes. So I'm listing them here. If I don't get to them in detail, we can cover them in the Q&A. Okay, so these 3 themes. Let's start with Basel III implementation. So I did want to emphasize that Basel III implementation remains a key priority for the committee in 2024. I thought I would start off just by reminding people what actually Basel III is, because it's sometimes confusing and people use many different terms to describe it. But essentially, Basel III has 2 planks, and the initial standards, which were finalized between 2010 and 2014 focused on the level and quality of regulatory capital, capital buffers, the GSIB framework, leverage ratio, liquidity ratio, and limits on large exposures. Now, these standards have been implemented by all Basel Committee member countries. And so they were already set and finalized in 2014. And note that these reforms do not result in changes to the risk-weighted assets framework. That is the denominator of the risk-based capital ratio. So this has remained largely unchanged since the global financial crisis, the GFC. What I'm going to spend most of my time talking about is the outstanding or final Basel III reforms, and these were finalized between 2017 and 2019. And these are very much focused on restoring credibility of the risk-weighted capital framework. And this was very much in response to the experience of the 2008 crisis. When that occurred, the market lost confidence in the risk-based capital ratio and reverted to much simpler measures of risk, in particular measures of leverage. Now, the implementation of these reforms started on 1 January 2023. This followed a one-year delay due to the pandemic. Now, these reforms are sometimes referred to as the Basel Endgame, I guess, in the US, or Basel 3.1 in the UK. I still refer to them as Basel III, so just the second leg of Basel III, but they have many different names. The key thing I wanted to emphasize is that these reforms do relate to the 2008 financial crisis. They are not new. They've been a long time in the making, and they should not be a surprise to anybody. Moving on, this slide shows the status of implementation across Basel Committee member jurisdictions. While implementation is delayed, good progress continues to be made. As you can see in the simple chart, around 60% of jurisdictions will have implemented by the end of this year. By 2025, if everything goes to plan, all committee member countries will have implemented, so it'll be close to 100%. There are a few caveats. There are certain elements that will probably extend beyond that, and these mainly relate to some of the more complex elements of the framework, things like the market risk framework, for example, which will probably, in some jurisdictions, be delayed a little bit further. But the thing I would emphasize there is that the market risk framework in aggregate accounts for a relatively small amount of risk-weighted assets, less than 5%. So the large bulk of the reforms will be in place by end 2025. The last point I want to mention here is that later this year, the committee will begin its regulatory consistency assessment program. This is a transparent program we've put in place to check national implementation against the agreed global standards. So to the extent that there are jurisdictional deviations from the Basel III standards, then these will be transparently identified. Okay, this table shows, the tables on this slide show common equity T1 risk-based capital ratios at different times for three regions. I'm just going to explain why I've put these up. It shows you the numbers for Europe, the Americas, and what I've called MAP, which is Middle East, Africa, and the Asia Pacific. I know it's probably an acronym that many of you haven't heard of, but sometimes we call it rest of the world, which I don't find very appealing. So I made up something else. I called it MAP. Anyway, I want to emphasize 2 points from these tables. If you look at the first one, the top panel, it shows common equity T1 ratios based on initial. So what I said was the reforms that have already been implemented, or if you like, current Basel III rules. And you can see that capital ratios actually did increase a lot. As we've said, we've increased the resilience of the global financial system significantly. So just for example, if you look at the Europe numbers, we went from 6.3% in 2011 to 13.6% in 2017. So a significant increase in capital requirements. The other thing you note from these charts is that top table is that most of the adjustment already occurred by 2017. Since then, the changes have been relatively small. So we've strengthened capital requirements. We haven't seen any evidence of detrimental effects on bank lending, on economic growth, but rather what we've seen is the benefits of having a resilient global banking system. The panel below is now comparing essentially initial, or if you like, current implementation of the Basel framework and what is the final Basel III package. So this is the end game, or 3.1, whatever you want to call it. And again, you can see the impact is really relatively small at the aggregate level and even the regional level. And if you look at sort of the map countries, the risk-weighted ratios actually go up. So they do also in the Americas. There's a relatively higher impact in Europe, but this is even taking into account assuming fully phased in and totally consistent implementation of Basel III reforms, which, based on current plans, that would in some jurisdictions not be till 2030 by the time the whole outputs law is implemented. And the other thing you note, if you look at that final Basel III numbers, you basically end up with capital ratios that look very similar across all the different regions. Okay. The next thing I wanted to emphasize, and this is a slide that comes from our regular data collection exercises, it's showing you Tier 1 capital, risk-weighted assets, and total assets as well. If you look at the red line in these charts, again, it's by 3 different regions. It shows you Tier 1 capital, and you can see capital has increased across all regions. But the line I want to focus on is the blue line. The blue line is risk-weighted assets. And as you can see in both Europe and the Americas, risk-weighted assets have actually declined considerably since 2011. They've gone up a lot in the rest of the world or the map countries, but elsewhere in Europe and the Americas have actually gone down. Now, there may be many reasons for that, and I don't really want to speculate as to why, but the point I want to emphasize is that there has not been any increase in risk-weighted assets since the global financial crisis. In fact, the opposite has occurred. And so the issues we identified as a result of the global financial crisis with respect to risk-weighted assets still remains to be fixed. And that's why implementation of Basel III remains our #1 priority. If you look at this chart, this is one more slide just to put into perspective the potential impact of the Basel III reforms. In these charts show the return on risk-weighted assets. So it's basically half-yearly profit divided by risk-weighted assets. And what you can see again is the red line shows the ratio given current rules, and the blue line shows the impact, again, once you fully implement consistently the Basel III package. And the thing that strikes you across all these 3 regions is that actually there's not much difference between the red lines and the blue lines. Again, for the rest of the world, the blue line is actually above the red line. So for the rest of the world banks, Basel III, in terms of its capital impact, is actually a benefit. And even in Europe, where it's slightly more impacted, the impact is not that great. There's some volatility from period to period, which just reflects volatility or variability in profit. But overall, the trend lines tend to be improving. And if you look at this number, this is a half-yearly profit. It's 1%. If you say annualize it and say that's a 2% return on risk-weighted assets, then overall that translates into a fairly healthy overall return on capital. So what I just wanted to conclude from this very quick outline of Basel III implementation, just to sum this first point up, is that implementation of the Basel III standards remains critical for improving the risk-based capital framework. In aggregate and by region, it's hard to see why there would be any material adverse effect on the banking system, on lending to the real economy, or to the macro economy more generally. Okay, that was my first point. Let me turn to the second point, which is the Basel Committee's response to the banking turmoil. I'll be very brief, as the story is well known to this audience, and there have been numerous reports published on this topic. The committee itself published a report in October last year. But a quick recap, what did we see? 5 banks with more than $1 trillion in assets failed. The bank failures in the US and the merger of 2 GSIBs in Switzerland triggered a broader crisis of confidence. So these charts over here on the right are basically just showing you the spillover in equity prices to other banks, to other GSIBs, and also to AT1 prices, which we all observed. And the last thing to point out is, again, what we all know is that there was wide-scale public support measures were put in place to help stabilize the financial system. So you had extension of depositor guarantees, central bank liquidity support, government guarantees. You had central bank FX swap lines as well. Now, moving in terms of the committee's actual ongoing work in response to these events, it's very much focused on prioritizing supervision. So through the course of this year, the plan is to follow up with publications that help supervisors address some of the issues we identified as weaknesses. So the focus is very much on addressing a whole series of questions about how to increase the effectiveness of supervision, what tools, processes have supervisors found most effective, are there any powers that are needed that supervisors don't have, what can we do in terms of assessing the sustainability of business models, how effective are different approaches to Pillar 2, what supervisory responses are most effective in addressing interest rate risk in the banking book and liquidity risk. And probably most importantly, what impediments are there to timely supervisory intervention? And the primary reason for focusing on supervision, I guess, are twofold. Firstly, the supervisory response is quicker and it's more targeted. And secondly, as I've just outlined in my first point, it can take a long time to implement globally agreed standards. So I think the supervisory response makes sense to start off first, and while at the same time we're still focused on implementing the outstanding Basel III reforms. I would say that doesn't mean that we think the regulatory framework is perfect. I don't think that's the case. We know there are weaknesses that should be addressed, potentially in relation to liquidity, potentially in relation to interest rate risk in the banking book. And I think there's also things to be learned about the role of AT1 capital in the framework and the types of rules around that. But I think these are very much issues that we would look to address over the medium term. The response to start is definitely a supervisory response. So that was my second point. My third point, Nicolas, you'll tell me to stop if I've run out of time, is the broad areas of ongoing work. We have a 2-year work program. So what you see now is largely a continuation of what we initiated last year. Very quickly, the first issue is around digitalization of finance. Here, what we're doing is updating a paper we published in 2018 on the effects of digitalization on banking, on supervisory approaches. It also covers various work outstanding in relation to crypto assets. On climate-related financial risks, we've already done a lot of work on regulation, supervision, and disclosure. We currently have a consultation paper out on disclosure requirements, which is very much based on the ISSB standards, and we hope to finalize that later this year. The third point is on the Basel core principles. The plan is to finalize, we've already consulted on these, the plan is to finalize these around April this year. These are a very important set of standards because they're the basis upon which the IMF does its FSAP assessments of national jurisdictions in terms of their effectiveness of their national regulation and supervision. There's work going on in relation to operational resilience. At the moment, this is focused on third-party service providers. We have some relatively old guidance that's in existence that we're looking to update. But I suspect this is an area that, perhaps even more will be done over the course of the year. And finally, there's always work going on in assessing risks and vulnerabilities to the banking system. Over the past 2 years, we've looked at low for long and then the sudden snapback in interest rates. We've looked at issues like changes in technology, banking as a service. Probably this year there'll be work on the impact of generative AI. It's not always very transparent in terms of the work we're doing here, and it's not highly visible. But I think it's just worth noting that these issues are something that are on our radar. Okay, I'll stop there. Thanks, Nicolas.
Thank you so much. There's so much to unpack here. Isabelle.
Okay, so I shall continue from a practitioner perspective and being seated at the committee as an observer. So maybe just what is the EBA and two main messages from me, I would say. So the EBA, Nicolas, you were pointing already to some aspect. The EU is simple, in my view. It's not yet a federal jurisdiction, but it's quite simple. So you would have the legislator, okay, the commission, the parliament. It's very democratic how we do banking regulation in the EU because we involve very broadly the parliament and the ministers. And then comes the EBA. So basically, I am Mrs. Single Rule Book here in the EU jurisdiction, so as to precisely help and support the right implementation of Basel III. I tend to call it Basel 3.0, never Basel IV. So this is my role to make sure that it will be implemented with all, I would say, more detailed implementation decrees, or normally in member state or jurisdiction, this would be the level or notices like in the US. So this is the role of the EBA, the European Banking Authority, and then comes the European Central Bank with its supervisory aids, so the SSM, Single Supervisory Mechanism, to have the day-to-day difficult charge of making sure that all the banks are okay implementing this set of rules, and of course, sailing. So the role of the EBA is large now, in the sense has been very much commented at least in the European jurisdiction, because we have 140 mandates, so-called mandates, which basically are supporting regulations to make sure that the Basel III will go ahead. So precisely, this is my twofold message that I wanted to share, also to follow suit with from Neil said, that we are in the time of the good Basel III implementation. And this is very important because it brings a lot. It has been showed by Neil that already, it has made the banking systems more robust, because they onboarded the incoming rules, as a matter of fact. And this, we should not forget what it brings. So we are very transparent in the EU in particular, because we show all the impacts in many details, and all along with the incoming measures and transitory measures also. Also, the Basel Committee has issued evaluation report. So we are all along accompanying this implementation. But the three things we note as practitioners here is that, of course, now we will get rid of the kind of model optimization risk with the output floor. It's very important. It's been a bit painful, as we know, but this we take is a very important measure now to make sure it will facilitate, I would say, that the model scope is rightly implemented. Not only the question of the level playing field, but in the end also taking out this optimization risk is very right in this special moment that we navigate, meaning a time of uncertainties. We are still in times of uncertainties. So also this question of, do the models reflect the history or the future to come, is also minimized thanks to this optimization risk being eradicated. So that's one of the very valuable assets. Another one is probably that we also increase the risk sensitivity also for the more standardized metrics, I would say, so outside of the modeling. So this is very important, probably for Europe, also for the rest of the world, or the Asian and Pacific area, because a large scope of banks is involved into implementing the Basel standards. So I think Europe is about a little bit of the extreme, but it's very important, this question of the scope. We know that also after the spring turmoil, it has risen again, and every jurisdiction is looking into this aspect. I will come back to it, because it has also some other interactions. So for us in the European jurisdiction, smaller banks, a lot of them would apply the standardized approach, and it's more risk sensitive. So we close the gap between I would say, the modeling standards versus the standardized standards. And this is important. And this also will help approaching better for the smaller banks this kind of difficult time that we navigate with more uncertainties. So higher risk sensitivity is also precious. The last highlight that I would retain with you here is the op risk. Op risk now is revived with much better metrics. So this is also very important because op risk involves so much nowadays, in particular given digitalization, but also being very sensitive to the relationship to the customers, the retail customers. we need also to upgrade, and this is what Basel III is bringing. So I wanted to highlight those very valuable assets in particular. Maybe my second point is about what is cooperation, because the Basel Committee, of course, it issues standards, but it is extremely important that we maintain the cooperative spirit, which is common to central bankers. Most of us would be central bankers. Also at the EBA, 80% of the staff is central bankers. So this is very, very precious in terms of the period that we are in. And just to illustrate, supervision will be the most important now because of the Basel III implementation. We had a period that we named a hard stop. We did not issue any other regulation. We should not intend to issue any other regulation. Maybe, okay, taking the minimal lessons that we need, of course, being vigilant. But it's very important that we focus on the implementation time, and good implementation goes first and foremost with excellent cooperation for excellent supervision, more than more rules. And myself, I am in this camp, also being the Mrs. Single Rule Book of the EU, because it is very important that we accompany the right supervision with excellent cooperation. So this is true, for instance, okay, let's take ICT risk. Let's take these dependencies to third-party providers, as we know, for instance, is a question that which arose also, or the concentration appreciation to some sectors. You know, all this. Maybe we should not even refine the rules, but make sure that common sense with good cooperation on how it happens on the ground is shared, basically. And the table of the Basel Committee is really prime onto that. The notion of the scope, I mentioned it already. I will come back to it because one of the main reasons for Basel III was also, I think, Neil, you mentioned the GC buffer, so the large interconnected banks. And interconnection is still an issue that we kind of look at. So we have new buffers, several rules, which are very good. But vigilance and cooperation, in particular in times of this heightened digitalization, is also what we should take a high attention to. So in particular, you know, looking at a scope for interconnection that is not only when you are large and international, but probably some other channels of the interconnection should be looked at. And this, I think we should do more with speaking to each other, cooperating, exchanging, rather than elaborating very difficult, complex, and infinite rules, because the channels of interconnections are multiple anyway. So let's keep a kind of human model first and foremost, and the table of the committee is there to provide this cooperation. Thank you.
Fantastic. Isabelle, you reminded us of the EU legislative process and the fact that lots of things that in other jurisdictions are done through rulemaking by specialized agencies, for example, in the US, the Federal Reserve, the FDIC, the OCC. In the EU is done in legislation involving, as you said, the European Parliament and the ministers. Can you remind us of the timetable for this? Legislation transposing what Neil calls the second leg of Basel III is now finalized, but not yet published. What's the latest?
Yes, sure. So the legislation is adopted by both the ministers and the parliament that we name the co-legislators. So now it will take probably something like 3-4 months. So, you know, in the EU, we have, I think, 20 languages. So we need to translate. And okay, there is the jurist-linguist layer, so that we make sure that all the translations mean really well the same thing. So Okay, and then it will be published, say, in between April and May. Nevertheless, we got in agreement with the legislators, so we meaning the EBA. So already you will find some consultation paper for the implementing regulations to be issued. We started with the simple reporting ones, disclosure ones. And then very soon you will have some of the most important that we are preparing on credit risk, operational risk, sorry. So we go ahead even before.
Thank you. No, that's a picture I wanted you to give us. And of course, these implementing standards or binding technical standards are prepared by the EBA, including this consultation phase, and then become EU regulations. So that's for some EU complexity I couldn't resist. Neil, Isabelle reminded us of the importance of the Basel table, right? I mean, authorities come to the tables, they have discussions, of course they issue standards, but they also exchange notes, form a common view on new challenges, etc. Can you give us more of a sense of how that has been evolving? Because, you know, everybody talks about, you know, global fragmentation, US-China antagonism. I guess, but you may want to correct me, that Russia is no longer at the Basel table, even it's technically a member of the Basel Committee. How does that play out? Can you, without revealing any Basel secrets that, you know, what happens in Basel should stay in Basel, but can you give us a flavor?
Yeah, sure. I mean, just to confirm that Russia is not at the table since the war started. Yeah, I mean, it's a Basel Committee process, and I would say it's a general BAS process. And you know, it's really just a matter of getting people around the table. It's a process of discussing issues in an environment where everybody feels comfortable, everybody knows each other. It's helped a lot, I would say, through the COVID period and pretty much since we finalized the Basel III package in terms of the regulation. I mean, the focus up until then was very much regulatory, and it was a bit, you know, a negotiation and trying to get that agreed. So that really took up most of our time. But since then, it has really been a lot more around discussion, trying to understand what's going on in different jurisdictions, basically understand the perspective of each other, where people are going. And really, it's just built on relationships and communication. And there's various groups we have, various sizes, various combinations. But ultimately, that's how it works. It's just people coming and meeting, knowing each other, and discussing things and being fairly open with one another.
You mentioned the fact that, you know, there tends to be a bias that, you know, it's a European and American thing, and the rest of the world is kind of an afterthought. That has been a criticism to the committee in the past. But as early as 20 years ago, I think there was a Japanese Secretary General of the committee. Can you give us a sense of how the committee expanded like 15 years ago, right, in 2008, to a number of large emerging markets, including China. Have these new members taken leadership? Do some of them chair committees? Can you give us a sense of that kind of long-term arc of expansion?
Sure. I mean, the committee expanded in 2019 initially, and then 2014 again, it went up to the...
You mean initially in 2014, right?
Yeah. But yeah, I mean, when I joined the Secretariat, Australia was not a member. I was called the non-G10 Basel Committee Secretariat person, and obviously that's changed a lot. I think somebody who recently came back into the committee and had been out for a few years just recently commented to me, actually, and said he noticed a really big difference when he left the committee. When the committee had just expanded, all the new members were relatively quiet, which is kind of what you'd expect. But now they're very much a leading. They take a leading role. I think if it wasn't for the new members, we probably wouldn't have ended up with as strong a capital framework as what we got, because they were all on the more conservative side, particularly on the Asian side. They'd lived through the Asian financial crisis, so they were all pushing and basically emphasizing what could go wrong. And they definitely do take a leadership role. I mean, you can look at that in terms of the chairs of our various committees. They're very active. I don't really see a difference in terms of contribution. Obviously, we have a lot of, the history is a lot, European and American and Japanese, but no, the new members are very active. Certainly.
So one of the things that the committee does, and you alluded to it, which really emerged in the 2010s, I think, and has been a bit of game changer, is this regulatory consistency assessment program, RCAP in the jargon. And famously, it found the EU 10, 20, 12 years ago materially non-compliant with the Basel standards of the time. And you mentioned that you would start a new cycle of assessments. Do you have a target date for when jurisdictions like the EU, the US, the UK will be, when the assessment reports will be published?
No, I mean, we'll only just start, as I said, later this year. We'll obviously start with the jurisdictions that have already implemented. And these are they're quite resource intensive. They take a lot of time. They're basically a line by line assessment as, what's the Basel standards say? What has the jurisdiction done? And then it's also an assessment of, how big are any deviations quantitatively? Are they material? And there's also a subjective element to it because, you can't quantify everything. These things for individual jurisdictions, they also involve visits to the jurisdictions, talking to the banks in the particular market. So they take several months. We've got a lot of countries to go through, a lot of jurisdictions to go through. I wouldn't expect us to get to Europe or the US before they've implemented. So it's not going to happen before 2025. So we'll start with the ones that have already implemented.
Isabelle, the European Banking Authority has been warning against deviation from the Basel standard in the legislative implementation. So now, as you said, the legislation has been finalized, even though it's not yet published. How bad is it? I mean, how super non-compliant is the EU going to be?
Well, so maybe just to rebound a little bit, I just received this week and the week before a Malaysian delegation from the central bank, one from India. I think this is, as Neil explained, facilitated because of this relationship. No, it would not have happened otherwise. They found their way to Paris La Défense. Okay, so
La Défense, of course, being the neighborhood where the EBA is located.
So on the implementation, well, I think at least in Europe, there are two things to say. One is that a large part of the law is in the hands of, as I said, parliament and ministers, which kind of puts a little bit of a distance from the pure central banking side or prudential objectives. So it embeds other objectives. So this is what makes it a bit difficult, this tension, but it has also the value of being fully democratic. So, one can appreciate also this. So that then where the banking system goes is also kind of backed by the democratic persons elected. The other side is that we are fully transparent. So you may refer to the recurrent reports of the European Banking Authority, which precisely gives it a full light of all the details. And we'll continue, because we have temporary measures. So it has been closing down very much the gap, and we take care of this. So even though the so-called RCAPs have not started, well, one would say they are available on the website of the EBA. So and the gap is closing very, very much every year.
Sorry, just for clarification, when you say the gap is closing, what gap are you referring to?
Well, the RCAPs, they are very objective. I'm sure Neil would say this. So they measure the distance in terms of capital adequation actually on the ground versus what is in the Basel standards. So you may measure 0.8% or, is pretty much like this. So we provide this kind of distance metric by metric.
Basically, what you're saying is that in 2014, the RCAP report on the EU found it materially non-compliant with Basel III at the time, the first leg. But the actions of supervisors and the EBA has reduced that, the corresponding gap in practice in terms of the effect with a fully compliant Basel III, right?
It is actually happening that way on the ground. The banks are, well, this is the virtue of the Basel Committee and the RCAP exercise. The banks themselves, they pay very high attention to fully load the standards. Then there are the so-called specificities, and this is true for the EU, for instance. Okay, we don't have a capital market union. We don't have profound capital markets deep. So we have less rated, for instance, institutions or companies. Okay, so how can you repair this situation? For instance, is one of the examples that it was chosen to have reference to non-rated companies and find a way to fix this situation.
Neil, we have a question from Dan Fihany, which is about the interaction between what you do at the Basel Committee and financial crime. Dan mentions the volume of illicit funds passing through financial institutions. I know that's part of operational risk, but can you give us a bit more granularity on how you deal with financial crime issues and also how do you interact with other standard setters in that area?
Yeah, I mean, sure. I mean, this is something where responsibilities vary across supervisors. We have a dedicated group that covers anti-money laundering and the countering of terrorist finance. But it's very much, from our perspective, it's as we do with all of these things, it takes a risk-based approach. It tries to improve practices in terms of how supervisors go about improving the way banks identify these risks and correct them. So it's very much a risk-based approach. We do interact with the FATF through that group. So
that being the Financial Action Task Force hosted at the OECD, right?
That's correct. That's correct. Thank you. Yeah.
Sorry.
So essentially, we have a technical group of experts that very much takes a risk management approach to this, shares practices across supervisors, and we also occasionally will publish guidelines or papers that try and improve practices. It's not a capital-driven approach.
Does the war in Ukraine change that landscape, or is it business as usual?
I don't think it changed the landscape so much, but it did bring a lot of the discussion from the technical group at the committee level in terms of basically, sharing of information as to what people were seeing, what were some of the challenges. I mean, it was very complicated even for the banks to comply with the sanctions, for example. So that was a big issue. So that was more about a compliance issue through a very difficult time and trying to basically facilitate as the most effective implementation that we could. But that did go to a much higher level than it ordinarily would. But maybe Isabelle actually can comment more on that than I can. She's probably more directly involved. But it did change things for sure.
Isabelle, has the war in Ukraine changed your job?
Well, it changed mainly because it created economic uncertainties. So this is what is now the impact. So since then, we have a special session on vigilance at our board. So, okay, inflation risk, does it change the metric, the evaluation, not only of the asset, but also of the capital, this kind of commodity prices. So every time we have a vigilance session, basically, that's the most important. In terms of the sanctions, we tend also to make sure that banks do their best in terms of the compliances. So you're
not directly related because the conversation started before the full-scale invasion of Ukraine, but the European Union is creating a new agency for anti-money laundering and combating financial crimes, the AMLA, Anti-Money Laundering Authority. The legislation is being finalized. We discussed it in the series. So it's going to be a new little sister to the EBA or brother. How is that going to change the landscape for you?
It's going to be a big sister, I understand.
Longer, but bigger?
Bigger in terms of the size of the staff, and also because, you know, AML, I think Neil was also highlighting this, is at the juncture of what you should do in terms of risk management when you are a financial institution, and what information you have to share and bring to more, I would say, police or justice authorities. So this juncture is the difficult management thing to put in this new sister or big brother that we will have in the EU, at least, because it will liaise all these types of authority. And
we have a question from. So we have a question from
a year and a half, basically.
That's right. A question from Rebecca Christie, moving on from financial crime to climate. The ECB has said that banks who don't align their balance sheet risks with their climate pledges could face a Pillar 2 capital charge, so supervisory discretion being applied, possibly due to legal and reputational cost risks, as well as the climate risk, and that this could take shape via the Basel process. Neil, how do you think about that?
Yeah, I mean, basically, as I said, on the climate risk side, we've covered Pillar 1 in terms of what banks can do and what supervisors can require in terms of trying to incorporate climate-related risks into their assessments of various risks. So how do you adjust, for example, the losses you may make on a loan? What is the likelihood that somebody will default because of climate-related risk factors? We've also, on the Pillar 2 side, we haven't gotten to the point that we've said, you should come up, this is a way of developing a Pillar 2 capital add-on, if you like. We haven't gotten to that level. It's been more around essentially the principles for how these risks should be managed, what banks should do, what supervisors should do. We don't really, at the Basel level, we don't prescribe for any risk. We don't say you should have an add-on for a particular risk. So we don't specify you need a particular add-on for any particular risk. We basically just set the broad guidelines for these are the risks you should consider. It could lead to additional capital, but that's largely left to the supervisors and to the national authorities to decide. And that varies for other risks across jurisdictions. So some jurisdictions will be very specific and methodical as to how they add on capital charges for specific risks, and climate may be one example. In other cases, they'll take a more general sort of holistic approach to the risk and may not have a specific capital charge.
So EU obviously is doing a lot on climate risk and a lot of regulatory initiatives, the taxonomy, lots of things. Is the EU pushing for the Basel Committee to do more in terms of global standard setting, or are you satisfied with the division of labor?
Is the question to me or to Neil, how he perceives?
It's a question to you.
Are you pushing me, Isabelle?
Well, it's for sure that the EU would want at least to be at the forefront, or is very sensitive to the issue. I think, first and foremost, it's illustrative, or also might say that we need to cooperate and exchange views, because we yet don't have a collection of financial evidence of the impact. And this is what we said in our EBA Pillar 1 report for ESG, calling for the collection of evidence and continuing to have data. Quite impossible to have a Pillar 1 charge, obviously, for the time being, but preparing with a Pillar 2 policy. So risk management, having transition plans, so that banks on board this type of risk in their risk management, and also with targets, so as to reduce the carbon footprint over a number of years. Basically, this is where we are by now. we are going to issue our own guidelines in this review, and I'm sure I'm trying to promote this at Neil's table next time. So this is how it feels.
Of course, I guess most of the audience is familiar with the Basel jargon of Pillar 1, Pillar 2, Pillar 3. So to simplify, Pillar 1 is the ratios, the kind of rules that are applicable to all banks, kind of mechanically. Well, again, oversimplifying. Pillar 2 is exercised by supervisors of their own discretion to put additional requirements for specific risks. And Pillar 3 is disclosure, market discipline. Moving from climate to digital, we have questions from Faisal Mansour about digital banks and virtual asset service providers. To what extent are these players subject to Basel III standards? Neil, can you remind us how that works?
So are you talking, is the question specifically about crypto
No,
assets?
it's a question about the scope of application of Basel III in practice. So if you think of a digital bank in the EU, in the US, in China, and I know you will say it depends what you mean by digital bank, but is it directly impacted by your rules?
Yeah, I mean, this gets back to the scope of application question that Isabelle was covering at the start. And basically, we don't define. All we say is that the Basel rules should apply to internationally active banks. So we don't define internationally active, and we don't define what a bank is. So we pretty much leave that to national jurisdictions to determine. And a lot of these, some of them would be, in my view, at the jurisdictional level, some of them will be banks, some will come under, money market funds. There'll be all types of different structures, but at the Basel level, at least, we don't specify. That's left up to national
we have a related question from Mark Sobel, who asks what the Basel Committee does on interaction between banks and non-bank financial institutions, or how do you divide this kind of work between the Basel Committee and the Financial Stability Board, which is also in Basel, but of course very different. And if you have broader reflections on the Basel Committee interaction with the FSB, the Financial Stability Board.
Yeah, no, I think that's very much part of our ongoing work. We saw during the crisis that a lot of risk had moved supposedly to non-bank financial institutions, but eventually it sort of ricochets back to the banking system because one way or another the banking system is connected to NBFIs. We've seen that more recently with cases like Greensill and Archegos. So that's very much a focus of ours. I mean, what are the interactions between banks and NBFIs? That can be very, very straightforward lending, exposures that banks have. They could be partnerships, they could be competitors, they could be through all sorts of different markets. And so what our focus is on is basically understanding what are the exposures banks have to these NBFIs. So a lot of it comes down to measuring counterparty credit risk, and that's an area of ongoing work. And then making sure then that risk is appropriately managed, whether it's through capital, liquidity, whatever the tools we have in place. But that's definitely a focus area for sure. I mean, the FSB is focused more from the perspective of, so we're always coming at it from this is a bank's exposure to an NBFI, and how do we manage that risk for the bank? Whereas the FSB is coming at it more from here. We have this large group of NBFIs. We need to make sure that them as a group, or those entities as a group, are stable, that they don't affect the overall stability of the financial system, and they may go in directly and provide more specific rules or guidance around NBFIs, whereas we're always coming at it from the interaction perspective.
And of course, NBFI, again, is non-bank financial institution. Isabelle, on this question of scope, both of you mentioned the fact that the EU applies the Basel framework to all banks, no matter how small. But the Basel framework is getting ever more demanding, and some would say complicated. So is it sustainable? In your view, will the EU continue applying Basel to all banks? I know you will say that's a question to the legislators, but how do you look back at the evolution of the last 10, 20 years for that matter?
No, thanks. It's always a very interesting question to study kind of the borders of what you want to protect with such prudential rules. So not only some non-banks, like we have the crypto issuers in the EU in the end on board, but also the smaller banks. So for sure, the direction of in the European jurisdiction is to keep the smaller banks in the loop, if I may say so, but with or more adapted rules. That's why it has been very important that we have this more risk-sensitive approach also in the standardized, so-called standardized and a bit more simple set of rules in Basel that we can now continue to apply to the smaller banks in the European jurisdiction. So the other point that we tend to have is can we not only have more risk sensitive but so-called more proportionate, so with less bureaucracy and for instance, for the time being, we are looking into integrated reporting so that we facilitate the life of those smaller banks and even disclose instead of them with the reporting figures that they give to their supervisors. So this kind of development is very much on the table. But not in the heart, basically the loop.
Coming back to your initial presentation, you had a slide where you showed the risk-weighted assets going down. And Christian Chavagnier is asking if you can say more about why you think that is the case and how you have studied that phenomenon.
Yeah, it's a good question. I didn't really want to answer it, but I mean,
That's
obviously,
it's
kind of surprising. It's probably not what most people thought. But to give the obvious answer, it's obviously banks have shifted into lower risk-weighted assets than what they had previously. And then there's some obvious, culprits, right? We all know the risk weight on sovereigns is 0, so most likely there's been an increase in sovereign exposures. I mean, even in the Americas example, where assets were growing, risk-weighted assets have fallen. So that we haven't studied it in depth, or I haven't to give you, but that's obviously one factor that banks have shifted into lower risk-weighted assets. They've maybe modified their portfolios more generally, and that's driven the reduction.
And of course, Silicon Valley Bank had a lot of sovereign exposure, so here we are. You mentioned the market risk framework. Can you give us a bit of an update and also how that's articulated with the fundamental review of the trading book in Basel and how these different market-oriented pieces of the framework fit together?
Sorry, say that again, Nicolas.
To you.
What particular aspect of the market risk framework are you interested in?
Yeah, this is an ignorant question for me. I would like you to update us on the fundamental review of the trading book, the FRTB, which has been a big contentious piece. And also, I should know, but I don't, how that is articulated with the market risk framework, which you mentioned.
Basically, it's, the fundamental review of the trading book and market risk to me is the same thing. It's a different way of saying the same thing. So that was part of this, that was the part that stretched out to 2019, and is also the part that is the most complicated part of the framework. And that's why I said it's most likely that implementation of at least some of the models, the internal modeling aspects of the fundamental review of the trading book is probably going to be most challenging. It's probably going to be the most challenging part to implement and the most challenging part to supervise. I think on the standardized approaches, still very risk sensitive. I think a lot of jurisdictions will push ahead with that before they necessarily start looking at the models part. In terms of the models part, there was very significant changes that occurred. That's why we called it the fundamental review of the trading book. It changed the way risk is measured. It's changed the way the models are assessed by supervisors. It's a bit more difficult to get approval to use models. So it's quite a complicated regulation, and that's why it's going to take a little bit longer.
we're at the hour. I apologize to Gonzalo Gassos and Korczak because they have very interesting questions, respectively, on supervision and on AI. We'll certainly come back to AI in future sessions, but it would have been good to have your views there. But we're past our time, so thanks so much to both of you, to Isabelle Vaillant and to Neil Esho, for an illuminating conversation about these very nerdy technical questions, but we all know how impactful they are. The next session of this series will be on February 6th. We'll discuss the reform of the Chinese supervisory framework, a very big change in the landscape announced last year with Meg Grismeyer and Yeling Tan. Again, many, many thanks to our two speakers, and have a great rest of your day.
Thank you.
Thanks a lot. Thanks. Bye.
Yeah. All the best.